Okay, fantastic. Thank you so much, everyone. Welcome to our July 21st, 2010 Forex training. This is a co-production between FXDD and FX Street. Our disclaimer is that we do not give buy, sell, or hold recommendations, and that trading is risky. You want to make sure you trade only with risk capital, which you can afford to lose in the Forex. All right, so today is another special webinar. This is really exciting in our series of anticipating the Forex trends. This is actually part 6, the game plan and the rules of the Forex trading game. I'm so pleased to introduce Greg Michalowsk. He is our FXDD Vice President, the Chief Currency and Trading Analyst at the company. Many of you know him from his speaking engagements around the world. Just an excellent guy to learn from. His Twitter account is twitter.com/GregMikeFX. I'm Sean Powell, one of the FXDD national trainers. I'm going to be along for the ride, helping you out, answering questions in the chat while we do the show. I'm also going to provide Greg with some of your questions when we go to Q&A. A little bit about FXDD. Actually, we have a pole position contest going on right now. If you didn't know, we're one of the sponsors of the Red Bull Formula One team. They are racing in Hockenheim, Germany this Sunday. Now, if the team does well, we provide you with a bonus. You can get all of the details at fxdd.com on that. We also have a trading contest going on where you can be one of the grand prize winners that get a chance, and this is a thrill of a lifetime, to go to an F1 race. We'll give you $5,000 for travel and accommodations to get you there. There are also many cash prizes and exclusive Red Bull merchandise that can be won. That is on the mini site as well at fxdd.com. So without further ado, let's go into a little bit of housekeeping. The training today is going to be on Forex market analysis, trading strategies, and we're going to show you how to find opportunities for yourself. Please participate. Make it great by asking questions. Put those in the chat. Keep them to the topic at hand. If you'd like to learn more about Greg and what he does with FX Street, you can go to blogs.fxstreet.com/fxtrader-link. That'll take you into all the details on Greg. So with that being said, I'm going to pass the ball and the microphone over to Greg. I'm very excited for Greg today. We're going into part 6, and I hope you enjoy it as well. Okay, Greg, so you have the floor. Go ahead.
I want to thank everybody for coming in here again today. As Sean mentioned, this is a part 6, and what that means is they're pretty much a series. So if you haven't seen any of our previous webinars here at FX Street, go back to the website and take some time and sit through them. I think you'll learn a lot. But as Sean said, we're going to talk a little bit about the game plan, the rules of foreign exchange trading, and this is the next step in a progression. I think last time we talked a little bit about the mission statement of Forex trading, and also about attributes of successful traders. And the mission statement for traders in the Forex market should be to make the most amount of money with the least amount of risk. If you focus on making well, first of all, every trader should focus on trying to make the most amount of money. This means that you're going to make $1 million. Doesn't mean you're going to take 5,000 and make it 30,000. No, that's probably unrealistic. Everyone's at a different level in their Forex trading. So for some of you, it may be to not lose money, but to just break even. That may be where you are right now in your trading. And for other people, it may be moving up to that point where you're going to actually make some more money. And the way that you increase your knowledge and your ability to and your success as a trader is through knowledge. It's through understanding when to make money, where you lose money, and being very disciplined in your approach and following things like rules. Now, I've shown this pop quiz probably in more than one of these webinars, but in regard to where traders make money and lose money, I see at FXDD, we are a Forex trading broker, that most money is made or lost in certain types of markets, and I've given you 2 types of markets. One is if the market is trending, and the other one if the market is non-trending. And most people, that is non-trending, moving around in a choppy fashion. And most of the time when I ask this question at seminars, people will say that they lose money, or most traders in the retail sector lose money in a non-trending market, a market that's chopping up and down, up and down, up and down. When reality, when most traders lose money is in trending markets. So with that knowledge, and with our knowledge of that, our mission statement is to make the most amount of money with the least amount of risk. we transition into how am I going to do that? How am I going to make the most amount of money with the least amount of risk? And the way that you do that is to trade the trends and keep your fear to a minimum. If the trend is your friend, fear is your enemy. You get the idea of the good and evil there. One is your friend, one is your enemy. You got the angel on one side, on one of your shoulders. You have the devil on the other side, and so you have to balance the two, and you have to be aware of that. Okay, I have to trade the trend somehow, some way, and I also have to try to keep my fear to a minimum, because what fear does to most traders is cause them to do the wrong thing. Just think, for those people who may be golfers out there, if you have, I'm a golfer, and I know if I have fear on a certain hole because perhaps there's water in front of the green, I'll invariably think about it too much and put a horrible swing on the ball and hit it in the water. And I'm sure there are other people out there who may have the same result. So you have to try to, as a golfer, I know myself, I have to try to see beyond the water. I have to try to, be able to see the green and not see the water. If I said, there's a comment here by Boyke that you said trading losses, now you say trading trends. I think what I meant to say, if I said the wrong thing, was that most retail traders lose money in trending markets, and that people trade in order to stop those losses. What you need to do is trade with the trend. So I hope that clears that. If I said that wrong, or if I caused some confusion out there, I want to find the ways that in order to make the most amount of money with the least amount of risk, what you have to do is try to trade the trends. Because right now most retail traders don't trade the trends very well. So that's where I'm going with that. All right, so so that is our game plan. That's our game plan. We haven't gotten to how you're going to do that, but we will progress toward those ideas, if not a little bit here, to touch a little bit on it here today, but in other webinars down the road. But just like in most games, before we get to that point, in most games what you do have is rules to the game, and in trading you also have to have rules to your trading in order. And so I have 5 specific rules that I apply to my game plan, and I encourage all of you to do it as well. And the first rule is to follow the KISS principle. And for those people who have heard me say this before, I often ask my audience, what is the KISS principle? Tools, by looking at too many maybe periods in charts, by listening and reading perhaps even too much fundamental news, and some people even try to create their own indicators by combining, let's say, 10 different tools into one that gives a bullish or bearish bias. No. My feeling, and through my experience of over 25 years of trading experience, what I've found is I've gone that way. I've tried to develop my own oscillators. I've tried to develop my own tools in trying to think that I'm going to be smarter than the market, that I'm going to somehow find a way that's going to me personally, is going to tell the market that this is the bottom or this is the top. And that's just not the case. What the markets are about, and what most successful traders do, is try to be like the rest. And if you think about the foreign exchange market, just think of how many people are trading the foreign exchange market at this time. For FXDD alone, we have tens of thousands of clients. Now add to that the string of other retail foreign exchange brokers who have, perhaps the same amount or similar amount of clients. Now add to that banks, add to that insurance company traders and money managers, add to that hedge fund managers, add to that central banks, adds that all this pools of traders out there, and you get an idea in your mind that there are just thousands and thousands of traders trading relatively few amount of currency pairs. We do about 40% of our volume in the euro versus US dollar. And then think of what they all know. And what they all know is a chart. They all know that the euro is trading at 128.0507 currently at the moment. They all can see the same picture. And what the majority of the people think is the way that the market's going to move. Is it going to move higher or lower from this 128.05, 07, 09 level currently at the moment? And so they're looking at that same picture, and the majority of the people are going to use simple tools in order to figure out a bias. Is it going to go higher or is it going to go lower? And so I also choose to use very simple tools in my analysis, and I implore you to do the same as well and try to think not like the market. Don't try to tell the market what to do and what not to do. You want to be like the market, because guess what? You cannot control the market yourself. The market is controlled by those thousands and thousands of traders who are looking at the same thing you're looking at, and the chart that you're looking at. So try to keep it simple. Try to keep it that knowledge that you want to be like the most of the people out there. Most of the people out there are looking at very simple things like moving averages, like trend lines, like Fibonacci retracement lines. I'll give you a clue. Those are my 3 trading tools. So that's the KISS principle. That's my theory behind why you should keep it simple and why I keep it simple. And all of it is focused on trying to be successful as a trader and keeping my fear to a minimum. My second rule for trading and trying to trade the trends and keep your fear to a minimum is always have a reason. You always need a reason to do a trade. If you don't have a reason to do a trade, don't do the trade. And that includes entry and exits. I often get questions from clients out there, oh, how do you exit a trade? And I say, well, how do you get into a trade? Well, I looked at the moving averages, I looked at the Fibonacci retracements, I looked at trend lines. I looked at some reason, and I took the price, and when the market price moved above the moving average, the 100-bar moving average on the 5-minute chart, I bought, and lo and behold, the market went higher. Great, that's a good reason to do a trade, and you always have to have a reason to do a trade. And by the way, it's not just the price is moving higher. You have to apply a tool to that price, and we'll get to that in a little bit. But you always have to have a reason to do a trade. So now, what about the exit? And they say, well, I have trouble getting out of the trade. And I say, well, you just gave me all these good reasons why you got in a trade. Guess what? You have those same reasons to get out of the trade. It's just the opposite. Either the market is going higher or the market is going lower. So apply the same tools and look for the same indicators that will tell you that the bias is if you were buying to get into the trade, that the bias is no longer bullish, that the bias is now bearish. And if you think in those terms, guess what? You'll be able to stay on trends for longer, and you'll be able to trade that trend and not exit early like I find a lot of retail traders do. So if you apply the same rules to get in, make sure you apply the same rules to get out. I also get people who ask me, okay, Greg, what about trailing stops? Can I use a trailing stop? Let's say a 25 pip trailing stop. And I say to them, is that a good reason to get out of a trade that the market hit a high and came down 25 pips? Now it's time to get out. And the answer, what I often find is no, because what if that 25 pip trailing stop comes in right at the 38.2% retracement line, and the market bounces off of that line and starts to move up? Well, you just got yourself out at a level where other traders, other smart traders, other successful traders are looking to get into the trend. Get into the trend. And so you can't, using a trailing stop to me is just is poison. You have to. I'd rather you wait, that you say, okay, I get out of the trade when the market went through the 38.2% retracement level. That makes more sense to me as a trader. So rule number 2, always have a reason to do a trade, and the reason comes from the tools that you will use to analyze the market. All right, rule number 3. I've mentioned the word tools, and I've mentioned a few tools, the tools that I use, including moving averages, Fibonacci retracements, and trend lines. But I do have some rules for those tools that you all should apply to any tools that you may want to use in order to trade the trends and keep your fear to a minimum. And excuse me, I have there are 3 requirements of any tool that I will use, and one is that the tool needs to be a trend defining tool. It needs to help you define a trend or stay on a trend so that you can benefit from trading the trends. Again, too many traders get off a trend too early. Too many traders trade against the trend. So we need tools that are going to define a trend and keep you on that trend. The second requirement is that you need tools that can help define your risk or our risk. If your tool doesn't tell you unequivocally that you should be bullish or bearish, and that only those 2 things, then you're not using a proper tool in my book. And that brings up another point in regard to what I mean by a tool that gives you an unequivocally bullish or bearish bias. And I'm really particular about this, and it comes in the form of the third rule, which is called I use unambiguous tools. And what I mean by unambiguous tools is that tools that define either bullish or bearish bias. And so an unambiguous tool will not tell you that the market is overbought or oversold. It will not be a tool that doesn't include everything in it. And let me give you 2 examples. A RSI or a stochastic, what does that tell you as a trader? It tells you that the market is overbought or it's oversold. And if a market is overbought, guess what? In a trending market, it can continue to get overbought. If a market is oversold, using an RSI or a stochastic, it can continue to get oversold. And for those people who follow the RSI or stochastics, go back to your May trading results and tell me, and look at your May trading results in for that month. And during that month, it was a month when the euro dollar really sold off rather sharply. It was straight down, and it was a trending month to the downside. And from a technical perspective, if you're using something like an RSI to apply to the price action during that month, what you probably found was that the market became very oversold very early in that trend. And so what we often find is that customers will buy against that oversold level. And what happens in a trending market, and especially a strong trending market that happened during the month of May, is that the market will have corrections that are very shallow. They will only rise, less than 100 pips to the upside, or certainly not anywhere near like a 38.2% retracement, or certainly not a 50% retracement. And maybe and so what traders will do is they'll look for opportunities to buy when the market is really starting to trend to the downside, and this gets them on the wrong side of the trending market. And the excuse is, well, the market's oversold and eventually it'll rebound. Well, what typically happens in a trending market using things like oversold and stochastics is that the market will only rebound a little bit, head back down again. And then when you do get a rebound in the RSI, it won't come back to your break-even point. And as a result, traders get on the wrong side of the market, and they continue to try to pick bottoms rather than sell the market and try to get on the trend. So as a rule for me as a trader, I've fallen into that problem many times in my past as a trader. So I decided at some point to finally get rid of the RSI out of my mind, get rid of things like stochastics, get rid of those oscillators that say the market is overbought and oversold, and instead use tools like moving averages, use tools like trend lines, use tools like Fibonacci retracement levels, which are unambiguous trading tools. That is, they give you a definitive buy or sell bias. If the price is above a moving average, guess what the bias is? Bullish. If the price goes below a moving average, guess what the bias is? Bearish. It's as simple as that, and it allows me to use those borderlines, those levels where on one side it's bullish, on the other side it's bearish, as a bias for my trading. So I know that the market moves below the 100-bar moving average on the 5-minute chart. I want to be short on an intraday basis. I want to see the market develop momentum in the downside. If I apply my fundamental bias to the market, I am more confident in that directional move. Now, I mentioned the word fundamental, and I have an opinion about using fundamentals as a trading tool. And fundamental analysis is indeed a tool for most people's traders. In fact, if I were to ask a lot of you people out there, what do you think about the market? 9 out of 10, if not 10 out of 10 people would say, I think the market's going to be going down or going up because of the Greek situation, growth in the euro is going to be stronger or weaker, growth in the U.S. is coming out weaker. You'd all give me a fundamental reason why the market is going to do what you think it's going to do. In fact, what most retail traders should do instead is to answer my question by saying, I think that the market is going to go down because we're below the 100-hour moving average, and we're also below the 200-bar moving average on the 5-minute chart, and the price is also below the 100-day moving average, and has been below the 100-day moving average and the 200-day moving average for quite some time now. So for those reasons, I think the bias is to the downside. Where are you wrong in that trade? Well, I'm wrong when the price goes above the 100-bar moving average on the 5-minute chart. And so that is the difference between a unambiguous and an ambiguous trading tool, is that I know from a technical perspective where the market turns from being bearish to possibly bullish, where it turns you around on the bearish highway. If you're driving down a road and you're thinking the price is going to go down, where is the market going to turn bullish? And that happens using unambiguous trading tools like a moving average, like a trend line, like a Fibonacci retracement level. And at the end, we'll go through just a few little examples of that, and we will continue in looking at those tools in future seminars and webinars down the road. But now a fundamentalist, someone who gives me a reason that they think the euro is going to go up or down, guess what? The market may not focus on that fundamental piece of news. For those people who are short the euro at 1.1875 or 1.19 at that level, guess what? You were listening to all the fundamental news that the euro was going to go down and go down to 115 and go down to parity, and everyone was focused on that news. If you turned on CNBC, all the analysts on there were talking about how the euro was going to head down because of the Greek situation. Well, guess what? It hasn't. It's gone back up to above the to the 130 level in the euro versus U.S. dollar. And for those people who are trading fundamental news, it hurt you. I mean, it started to rally, and it wasn't just recently that the market started to rally. The market really found a good technical bottom at the 118.75 level and started to move to the upside. So what I'm saying is that fundamental news is good to know, but what I I think it's an ambiguous trading tool, and what you have to instead focus on is some technical tools that are going to give you an unambiguous bullish or bearish bias. and then supplement it with your fundamental perspective. But don't primarily rely on a fundamental news in order to enter a trade or to even exit a trade, because it's never going to tell you a price level. It's going to just tell you a bias, whether you're bullish or bearish. But if you follow the technicals, it will tell you when to get in a trade. It'll also tell you when to get out of a trade. Now, I have a quasi rule as far as the tools I use, and I use 3 tools in total, no more than 3 tools. If you have too many tools that you're following, guess what that's going to do to your fear? Your fear is going to increase. You're going to have too many counterbalancing things going on in your mind. This is bullish, this is bearish, this is bullish, this is bearish, and that's just going to confuse you, and you're going to have either analysis by paralysis, or you're going to put the trade on, and immediately you're going to start focusing on the other tool that is showing, a bearish sentiment when you just went long. So try to keep your tools to a minimum, and try to, and I use 3 in particular, because too many add confusion and fear. My 4th rule is this. Excuse me again. Is the if should rule. And my if should rule. This is something that I've made up, and it's very simple, and it makes a lot of sense, and it goes hand in hand with using things like unambiguous trading tools. But it is simply this: if the market price does X, Y, Z, then the market price should do A, B, C. If the market price does not do what it is supposed to do, get out. Get out. And by that, actually, I'm gonna put on a chart here. Figure I might as well show you guys a chart. Let me put it back on here. And here we have the euro versus the U.S. dollar. I assume everyone can see the chart. Someone just give me a yes. Anybody? Yes, good. Okay. Let me see if I can. All right. Here is a chart of the euro versus U.S. dollar, and this blue line represents the 100-hour moving average. The green line is what I call is a 200-hour moving average, and these are the tools, the moving averages that I use in my analysis. And what we see here is that, or what my trading rules are, is if the market breaks above the 100-bar moving average, that is a bullish bias, okay? So you should be looking to go long the market. And you can see here the market broke above the 100-bar moving average at this point right here. Now, the 200-bar moving average, in my mind, is the confirming moving average, and that confirms the move to the upside. So my if-should rule says if the market, once again, I'll repeat it to you in a verbal way. If the market price does X, Y, Z, then the market price should do A, B, C. If the market does not do what it's supposed to do, get out. So in this case, if the market price breaks above the 100-hour moving average, the market price should move higher. If the market does not do what it's supposed to do, then get out. So in this case, the market price moved above the 100-bar moving average, went to the confirming moving average, and we should see the market move higher. And that's exactly what it did. When we come down to this point right here, and the market tests the 100-hour moving average, someone who's trading this market might say, if the market price tests the 100-hour moving average, the market price should hold that 100 moving average, and the market price should go up. So the market is trending to the upside, comes down to the 100-hour moving average, and a trader might sit there and buy against this 100-hour moving average, expecting the market to go up. In this case, if it doesn't do what it should do, in this instance, what it does is it just rallies up a very minor amount, and it breaks below the 100-hour moving average. Guess what you should do? Get out. It's as simple as that. And so, it's a simple rule that I apply, but you'd be surprised how many people will sit there and buy, have a reason to do a trade, do the trade, see it go in their favor a little bit, and then when it comes down below this moving average line, continue to stay in the trade. What was the reason to do the trade? Because it was against the 100-hour moving average. What is the reason? Why should you still be in the trade if the market price is trading down here? You shouldn't. You should get out of the trade and look for another opportunity, because there will be another opportunity. That's the one thing I can guarantee in trading, is that there will always be another opportunity. So follow the if-should rule. And if you follow the if-should rule, you're going to save yourself a lot of money. The other thing is if you trade for a reason, if you trade at these key levels, guess what? Your risk is going to be limited. And if your risk is limited, guess what your fear is going to do? Your fear is going to be limited as well. So we do have a question here that I'll attend to. Your rule is that the 100 moving average is a trigger and the 200 is a confirmation. What do you do when the price breaks the 200 moving average first and then the 100? Well, that's a good question. That typically happens when the market is in a non-trending period. That is the market is moving up and down, up and down, up and down. Excuse me. And let me see if I can find a situation like that. So here the market breaks the 100 and it goes below the 200, and then it breaks above the 200. So this is the case where the market breaks above the 200 and goes through the 100 at this point. This is a non-trending type period, and what I look for and what my rules are is that if the market breaks the 100 bar moving average, we should go through the 200 to confirm the move to the downside. Now, this gets to another situation of the if should rule. Now, if the market breaks the 200 bar moving average, it should continue down. We should see a continuation of the trend to the downside. If it doesn't, that is, if it moves back above the 200 and moves above the 100, guess what? It's not. If it moves back above the 200, it's not doing what it should do. It's not continuing the trend to the downside. We should see the confirmation of the trend and a continuation of the move to the downside here. We don't. We see a reluctance for the market to move in that direction. I mean, it does. I mean, it does come down here, and it looks like the market's going to move lower. But when we get 1, 2, 3 bars and we're back above that 200, that's where you start getting out of the trend right here. And either you're looking for a reversal where the market's going to continue in that direction and move above the 100 bar moving average, in which case, it failed on this move, gone down. But in most cases, most cases, what normally happens is the market is in a consolidation period right here, and the market tries to establish an identity as far as which way it wants to go. I mean, granted, it does the same thing here. It goes below, it goes above the 200 bar moving average, and it should go higher, right? And it doesn't. It comes back down below. So this gives you a bias back to the downside. So I'm always focused on what it does last. I hope that answers your question in that you go through the 100, we should see, we go through the 200, we should see higher prices if we don't get out of that trade. And if it goes to the 100 again, we should see lower prices. And in this case, it comes back up to the 100 and then moves back up 100 and starts what is a normal trend to the upside. Does that answer your question? I hope it does, and hope it clears things up. But you're always looking for the market to do what it should do, and if it doesn't, then you want to get out of that trade and reevaluate. But in most cases, not when it's bass backwards, when you start to go through the 200 and then the 100, like we did here and like we did here. The market is more in a consolidation period. It likely not to trend, but this is a clear sign that the market is trending to the upside. So I hope that answered your question. So anyway, that is my if should rule. So let's look at the current market here. This is the euro versus US dollar. And what we've seen here is the market broke through the 100 bar moving average. Now the 100 bar is still moving to the upside, and we come down to another support level, actually a 38.2% retracement. So, which is another one of my tools. So although the market went below the 100 bar moving average, giving a bearish bias here, we did find buyers against 38.2% retracement, and that helped push the market back up to the upside here. Toward the end of the day. But notice here that the 100 bar moving average started to take control again at this point right here, and the market started to use that level as a level of resistance. And even though the price did move briefly above the moving average here, we're in a non-trending type pattern right here. And normally when the market non-trends, it looks to trend. But you can see how the market gave one last test of that 100 bar moving average, failed on that level, And in fact, if I zoom in closer here, what you see here is a big, huge tail here, which for those people who follow candlesticks will know that that is a failure of this move to the upside. And in the next bar, the market tries to go up and get above that line again and fails again, and that starts to move to the downside. Where do we go and find support? We go and find support against the 200-hour moving average on the chart here. It goes down to a low of 127.91. The 200-hour is 87, and the market consolidates and is now in between support and resistance in this chart. So that's what I mean by the if-should rule. And again, the if-should rule says, okay, if the market stays below the 100-bar moving average, we should go lower. Where is your stop on this trade, folks? Where do you get out of the trade if the market moves below this 100-bar moving average and stays below this 100-bar moving average? Your stop is right here. Is a new high. Is a new high right here. You're using this as a crutch to lean against, as a reason to do a trade. This is your reason to do the trade. We failed, or we came down here at 38.2, gave you a reason to trade. The market moved back above, started to move below this level right here, and this test right here, after this failure right here, was the key level to get enter a trade, because your risk is just this amount. And that's what you have to do in order to be successful as a trader, is limit your risk and then have the market move your way. Get lucky in the trade, have the market move your way. But I always like to say that good traders make their own luck. And in this case, because you're trading against, you have a reason to do a trade, and you apply the if-should rule. You know your risk, you define your risk, and you're able to benefit from this. Down here, what do you have? What kind of choices do you have? If you're trading this market from the short side right here, guess what? You have support at this 35 level. You have support against this 200 hour moving average. When the market moves through this 35 level, what does it do? It comes down, tests that line, and notice the high here since that point, since the break of that line right here, comes back up to 36, and we're using that level as a ceiling right now. So right now the market is in between support against 200, resistance against here. Good traders will either sell against 38.25, this level right here, or buy against here. If the market breaks, they'll sell. If the market goes above, they'll buy. Why? Because what is their risk? Their risk is a small amount, and clearly the market is defining the risk in this trade. The market market traders have a reason to do a trade. They understand what their if-should rule is, and they trade near these key levels where the market is market price, and the tools that you use are going to tell you when to get in and when to get out. So everyone understand that? Okay. All right. I see your question, Raphael. I'll get to that in a second. I want to finish up my final rule of trading, and then we'll finish up with some questions here. So let me take that off for a second here, and I'll get back to my PowerPoint here. All right, so that's the if-should rule. I hope everyone understands that rule, and put it on a note card. Put if ... should, and just as a reminder, because once again, what I often see in the market is that retail traders will be stubborn with their trades. They'll do all this work to get in the trade, and then they don't apply the reason why they get in a trade to use as a reason to get out of the trade. If you're buying against the 200-hour moving average, guess what? If the market breaks the 200 moving average, it's not doing what it should do. The market is not doing what you thought it should do. Get out of that trade. So don't be stubborn. Follow the if-should rule. And the final rule that I have is always keep your eyes on the road ahead. And I mentioned the idea of being on a bearish or bullish highway, and I specifically use that visual, that analogy that if you're trading a trend and your objective is to stay on the trend and trade that trend till the trend says it's no longer viable right now, what you have to do is you have to look down, visualize yourself driving down a bearish highway. Visualize that chart that we just saw on the euro dollar on the break of the 100-hour moving average, and it's driving down the highway. I mentioned the 38.2% retracement level. That's an exit. That's a target on that highway. And if you are driving down that highway and you pass that target, if you pass that exit, guess what? You're staying on that bearish highway. You're continuing to drive forward. And guess where your next exit is at? Your next exit in the chart in your mind of that euro dollar is now targeting the 200-hour moving average. And it's got to get through that 200-hour moving average in order to stay on that bearish highway, to stay on that bearish trend. Has it been able to get through that 200-hour moving average yet? No. Has it really turned around and said that it's time to be bullish? I would say no as well. Why? Because we have to get above that 35 level, that 128.35 level. And that, in my mind, would be the indication that, guess what? You're now going the other way, that you move back above the 38.2% retracement level that was support early in the day. We broke through it. We hit the exit at the 200-hour moving average. We're not able to get through that level, but I still need a reason to think that, okay, the bias is turning the other way and that I should probably be a little bit more bullish here. Now, is there a reason to be bullish at the 200-hour moving average? Yes. Why? Because we didn't get through it, okay? We didn't get through it, so that means that the bias is a little bit more bullish. All right. Well, I'll take your questions now. If you have any questions in regard to specific charts or anything else specific in regard to this, put them in right now and be happy to answer. You know, I see Rafi has a question. What's the better time frame to trade with moving averages? Rafa, I look at three different time frames, Rafa. I look at the daily chart, I look at the hourly chart, and I look the 5-minute chart. And each of these charts have the same tools on them. I use the moving averages. I use the Fibonacci's. I'll put in trend lines as well in them. I'm always looking for reasons of why levels that I want to be concerned about. Easy levels that the market sees. Obviously, low. I'm going to put a trend line. Easily high. I'm going to put a trend line. So this becomes a target on the downside. And the tools that I use. Oops, sorry. No camera. Hold on a second. There. Do you see my charts now? All right. There. Just give me a yes. Someone. You see the chart? Okay. So I look at the daily chart. I look at the hourly. I look at the 5-minute. And each of these charts, I have the blue line and I have the green line. The blue line's always my 100. The green line's always my 200. What does this say right here? The blue line's going sideways. It's saying the market is consolidating. It's non-trending. What does it say here when the 100 and the 200 converge at the same time? It's saying the market is consolidating. It's non-trending. What does it say when it breaks and we start to see momentum or we see moves through this support level at 128.69? It's saying the momentum is turning to the downside, that the bias is to the downside. Traders could trade against these levels right here and find the market moves up and down, up and down. So you can trade off this 5-minute chart, get a good level to sell against, and have an idea of where you want to trade. And you can get a bearish bias off of this 5-minute chart. It's at 128.93, or really you get a bearish bias at 128.69 as well when we have these lows broken right here at this level. This gives you a bearish bias here. But this is the same bearish bias as something like this on the hourly chart where the market failed at the 100-hour moving average. And what I find, Rafa, is that that the market tends to look at this 100 bar and then looks at the 200 bar moving average. If you listen to CNBC, if you hear and someone talks about technical analysis, what they'll often say is, well, the 100 bar moving average, or the 100-hour moving average, or the 100-day moving average, or the 200-day moving average in the S&P. They rarely talk about technicals, but when they do, they talk about the 100 and 200, and that's what I use in my analysis. And I'm always looking for just clues from the market to tell me, all right, what is my bias going to be? So in this case, coming into this day, I knew that the 100-hour was going to be a key level up here. I also knew off of the daily chart, look at the daily chart, look at the 100-day moving average. The 100-day moving average came in yesterday at 129.09. Coming into today, what is this level? This is 129.08. So we had two reasons, one off the daily chart and one off the hourly chart, to think that there's going to be good that this area right here at 129.09, and also this is a 38.2% retracement of the 2010 trading range. This is the high for 2010. This is the low for 2010. Comes in at 129.09. Tell me that 129.09 is not an important point. We have the 100-day moving average, we have the 38.2% retracement, and we have the 100-hour moving average. All of them are important, and that's why this level was so important from a technical perspective. Moving on to the 5-minute chart, it confirmed the move on a move through the 28.93, and the market started to move to the downside. So I use all three of those charts, but those are the only three charts that I use, and I'll try to find clues from each of them. And if I can find charts where a daily chart and an hourly chart and a 5-minute chart all confirm the same thing, guess what? I'm more confident in that trade, and that's what you should be too. And that allows you to stay on the trend, to anticipate that we're going to have a trend move to the downside. Where does the trend end right now? Well, it ends at the 200-hour moving average, and the market is a little bit, going to have trouble here at this level. But be sure to know that if we break the 200-hour moving average, guess what the if-should rule says? The if-should rule says that the market should go lower. Guess where we can go? We can head down to the 61.8% retracement of this this minor move to the upside here in the euro versus US dollar. It's not even the big move. It's just the minor move. And so we have a potential to head down to 127.15. That's the target. That's one of the targets. That's an exit on the highway. That's what I mean about trading and staying on the trends, is following those levels. Are there any more questions? Comments? Anything else? All right. I hope everyone learned something here today. We didn't go through a lot of charts, but what I did go through certainly, or what I think is that some things that allow traders to develop a firm foundation for your trading, and to start thinking about the markets in terms of staying on the trend and following the trend, and also following some certain rules in regard to that idea, so that you can stay on the trend, define your risk, keep your fear to a minimum, use tools that are going to be to your advantage and not to your disadvantage, and from there, you're better suited, you're better able to trade the trends and make more money and be more successful as a trader, not like those other traders who don't trade the trends, who do poorly in trends. You want to be better in your trade, in your trends. So make sure that you apply some of these ideas and rules to your trading. I think you'll find that you're much more successful. So I really appreciate it for everybody. And if you have any questions, you can always send me an email at greg@fxdd.com. If I didn't get to any of your questions, feel free to go there. I'll put it up right there. And thank you very much to the people at FX Street, Vicky, Maud, and company for all that you do for your customers out there. It's a great service that you apply. Thank you very much.